While the mainstream financial media remains hyper-fixated on the speculative fervor of the AI bubble, trade tensions with China, or the high-stakes political drama in the Oval Office, a far more systemic risk has been brewing in the shadows. This threat isn't found in Silicon Valley or Washington, D.C. It originates in the boring world of Japanese government bonds, or JGBs, a niche often ignored by everyone except those who have ventured deep down the finance rabbit hole. This obscurity is precisely why it is so dangerous. If you have been scratching your head wondering why U.S. mortgage rates refuse to budge despite cooling inflation, why global equities suffer from sudden, inexplicable flash crashes, or why financial conditions remain suffocatingly tight even when the Federal Reserve hints at rate cuts, the answer doesn't start with Jerome Powell. It starts in Tokyo. To grasp why Japan holds the remote control to the global economy, we must travel back to 1992. 3 decades ago, Japan's massive asset bubble, one of the largest in human history, burst with catastrophic force. Real estate values vanished, the stock market went into a multi-decade freefall, and the country entered a period of economic paralysis known as the Lost Decades. For 30 years, Japan existed in a state of financial stasis. Zero growth, the engine of the world's then second-largest economy, stalled. Deflationary trap. Prices refused to rise, and wage expansion became a relic of the past. The pause button. It was as if the entire Japanese economy hit a wall, and no amount of traditional stimulus could find the restart switch. Faced with total stagnation, the Bank of Japan resorted to extreme measures that broke the laws of traditional economics. They didn't just cut interest rates to zero, they pushed them into negative territory, effectively charging banks to hold cash. When that failed to spark life, they introduced a Marvel villain-sounding policy called Yield Curve Control, or UCC. Under UCC, the Japanese government essentially superglued long-term interest rates to the floor. They vowed to cap bond yields regardless of market forces, effectively nationalizing the price of money. This policy created a massive dilemma for Japanese institutional investors, pension funds, life insurers, and commercial banks. With domestic government bonds yielding 0% or less, they were faced with a grim choice: accept zero returns or go shopping overseas. They chose the latter. This triggered a multi-decade global shopping spree, transforming Japan into the world's largest net creditor, the top foreign holder of U.S. treasuries. They became the price-insensitive buyer that kept U.S. debt affordable, and the global duct tape. Quietly and invisibly, Japanese capital became the adhesive holding the international financial system together. Now, after 30 years, that duct tape is starting to peel.